listen to me, because what I am about to tell you is the difference between keeping the money you worked a lifetime for and handing it over to the IRS on a silver platter. You are 60, 65, maybe 70 years old. You've started a little consulting business, maybe you're selling crafts, or you're finally doing that freelance work you always dreamed of. You are self-employed now. But here is the problem, you are thinking like an employee, and if you do that in 2026, you are going to go broke. The fear is real. You're afraid of an audit, you're afraid of the paperwork, and frankly, you're afraid that the government is going to take such a big bite out of your side hustle that it won't even be worth doing. But I want you to stand up in your truth right now. In 2026, the tax laws have shifted. We have new thresholds, we have the one big beautiful bill impacts, and we have rules that can either be your best friend or your worst enemy. The question you should be asking isn't, how do I pay my taxes? It's, how do I make sure I don't pay a penny more than I legally owe? First, let's talk about the big one, the Qualified Business Income Deduction, or the QBI. People thought this was going away, but listen to me, it is here to stay. In 2026, if you have a simple sole proprietorship, you can likely deduct 20% of your qualified business income right off the top before you even look at your tax rate. And here is a 2026 gift for you. There is now a minimum $400 QBI deduction guaranteed if you have at least $1,000 in business income and you're actually working the business. That is a floor, people. It's the government finally giving you a little bit of a break just for showing up. But you have to be careful. You have to know what you can actually write off. Let's start with where you are sitting right now, your home office. If you use a part of your home exclusively and regularly for your business, you can deduct it. But don't you dare try to claim your kitchen table. The IRS is watching. You need a dedicated space. In 2026, you can take the simplified method, $5 per square foot up to 300 feet, or you can do the actual expense method. If you're retired and your home is paid off, the simplified method might be easier, but if you're still paying a mortgage and utilities are skyrocketing, the actual expense method, where you take a percentage of your mortgage interest, your heat, your lights, even your Wi-Fi, could save you thousands more. Now, let's talk about your car. Are you driving to see clients? Are you picking up supplies? In 2026, the standard mileage rate is hovering around 70 cents per mile. Think about that. Every time you drive 100 miles for business, that is $70 that stays in your pocket instead of going to Washington. But you must keep a log. No log, no deduction. It's that simple. What about your health? This is where most retirees miss the boat. If you are self-employed and you have a net profit, you can deduct 100% of your health insurance premiums for yourself and your spouse. This is an above-the-line deduction. It lowers your adjusted gross income, which is the magic number that determines if your Social Security is taxed or if your Medicare premiums go up. Do you hear me? This isn't just a tax break, it's a way to protect your retirement benefits. And for my 2026 entrepreneurs, don't forget the equipment. Did you buy a new laptop? A new printer? Under Section 179, you can often write off the entire cost in the year you buy it. You don't have to wait 5 years to get your money back. You take it now. I also want you to look at your SALT, your state and local taxes. The cap has finally been raised to $40,000 in 2026. If you are itemizing, this is a massive win compared to the old $10,000 limit. It means your property taxes on your home and even your business vehicle can finally work for you again. But here is your actionable takeaway, and I want you to write this down: stop commingling. You must have a separate bank account for your business. If you are paying for your business labels with the same credit card you use for your groceries, you are asking for a nightmare. In 2026, the IRS reporting thresholds for $1,099K and $1,099 NEC have moved to $2,000. That means you might not get a form in the mail if you earned $1,500, but you still have to report it. If your records are a mess, you will overpay because you'll forget what you spent. Listen, being self-employed in your 60s and 70s should be about freedom, not about being a slave to the taxman. You have the power to keep your money. You have the write-offs for your phone, your internet, your marketing, and even your continuing education. If you take a class to get better at your craft, write it off. You have worked too hard for too long to be powerless. Take control of your deductions. Keep every receipt. Understand that in 2026, the law is actually leaning in your favor if you know how to use it. With that said, thanks for watching, and until next time.